There's all kinds of different products you can choose to grow your money in the market, and they can range from very low risk to very high risk. So, choosing which type is right for you really depends on your knowledge of the markets, your risk tolerance, and the goals that you are trying to achieve. And these different investment products can be broken down into different categories known as an asset class. An asset class is going to be a grouping of investments that behave comparably in the marketplace and are subject to the same rules, laws, and regulations. And some of the most common asset classes are going to be equities, fixed income, real estate, and commodities. Now, in general, all these asset classes are expected to exhibit different risk and reward potential, and they also perform differently under certain market conditions. So, depending on your strategy, your goals, and your risk tolerance, you can choose to use one type of asset class, or you can have a mixture of different asset classes. When you choose to have a mixture of different investments, you are designing what is called an investment portfolio. And part of the design is dedicating a certain percentage of your total funds to certain asset classes so that it can stay in line with your risk tolerance, your goals, and investment timeline. Because these different asset classes all come with different risk and reward potential. And anything with high reward is going to come with high risk. And anything with low risk is going to come with low reward. So it's important to strike a balance between the two so you are able to meet your financial goals within your investment timeline. When we refer to risk, we are mainly concerned about volatility. Volatility is a term used to measure the rapid price fluctuations over a period of time. Some assets can be more volatile than others. So assets that are highly volatile will come with more risk depending on how long you plan to invest for. And the timeline that you have to invest your money will greatly depend on which asset you should invest your money in. In the short term, certain asset classes can experience large price fluctuations. So if you think you need your money soon and we're only thinking of investing for a few months or years, then you wouldn't want to invest in a volatile asset because there will be no way to know if the value of your investment would be up or down by the time you need your money. But if you weren't needing your money for, let's say, several years or decades, then it would be okay to invest in a volatile asset because generally, given enough time, assets tend to rise as the economy grows. So let's go over the different asset classes, and we'll start here with equities. Equities is just a fancy term for stocks. When you invest in stocks, you are buying pieces of ownership of that particular company. When you own shares of a company, the value of your investment increases when the price of the shares become more than what you paid for them. So your investment really depends on how well the company does. If the company does well and appreciates in value, then your investment will grow as well. But if the company does poorly, then the value of the company can decline and so will your investment. So investing in equities doesn't guarantee positive returns. So there will be more risk involved when investing with equities. But they also provide high returns when they do well. Now, equities would be classified as a highly volatile asset and would fall under the high risk, high reward spectrum. The next common asset class is going to be fixed income. Fixed income is a type of investment where investors are paid interest at regular intervals until a maturity date is over. And once that maturity date is over, that investor will receive their initial principal investment back. So think of this as you loaning your money out to someone and they have to pay you back by a certain date. But every month until that date, they have to pay you an interest payment in exchange for you letting them borrow your money. Now, this isn't going to generate a large amount of returns, but it's low risk because there isn't large price swings and your money is likely to be protected from losing value. So some common fixed income products you can invest in are going to be government and corporate bonds, treasury bills and bonds, certificates of deposits, or simply an interest-earning savings account. Now, just because you park your funds in an interest-gaining savings account or some of these other fixed income products doesn't mean it doesn't come without any risk at all. While a savings account protects capital from losing value, its low returns can put you at risk from achieving your financial goals. The next one is going to be real estate, and that is just land or property. And these can be grouped into three main categories: residential, commercial, and industrial. And this is a great asset class because it can offer stable income returns from the rents paid by the tenants of those properties. And contrary to popular belief, you don't have to have lots of money to invest in real estate. What small investors can do is purchase real estate by buying REITs, which stands for Real Estate Investment Trust. REITs are companies that own and operate income-producing real estate, and they pass most of that income on to its investors. Now, you can buy shares of these companies just like you would buy shares of a stock. And REITs can be a solid part of any portfolio because they provide some of the highest income returns throughout the market. And this type of income can be really important, especially for retirees to help out with their living expenses. Now, real estate can range from high risk with high returns or low risk with modest, steady returns. So this can be subjective to the type of real estate investment you are looking at. But generally, real estate provides more returns than fixed income, but over time doesn't produce as much return compared to equities. So I would put real estate in the medium risk, medium reward spectrum. And the last one we're going to talk about here is commodities. And these are things like gold, oil, or wheat. And there's so many different commodities out there that they are broken down into three main categories: agricultural, energy, and metals. Now, commodities are often used by investors to park cash during volatile or bearish equity markets because commodities tend to move in opposition to equities. And the commodities market can be the most volatile asset class. So commodities can have large price fluctuations like equities where capital appreciation isn't guaranteed. So investing in commodities falls under the high risk, high reward spectrum. So I wanted to take a look at the performance of some of these different asset classes. And this is going to be 9 months of performance dating back from January 1st, 2019 to September 25th, 2019. And I just pulled out some examples here just to show you the difference in volatility in some of these asset classes. And I'm not recommending these products, I'm just using them as an example. I've made a little legend here. E stands for equities, F, fixed income, R, real estate, and C, commodities. And the color of the letter is going to represent the line of the asset class that the graph represents. So C right here, which is yellow, is going to be this yellow line right here, and look how volatile it is. There's large price fluctuations. I mean, this thing can move 10, 15, 20% in a matter of a couple months. It could go up that much, and then it can go down just as much and just as fast as it went up. So it's very jaggedy, very rigidy, lots of volatility in commodities. So if you take commodities and compare that to, let's say, fixed income, which is going to be this red line, look at the steady line that it has. It's just steady growth. There's not much rigidity action. It's just steady. And then we take a look at equities and real estate. They both kind of have the same volatility. And over this 9-month time span, they look like that they perform pretty close to each other. So hopefully this illustrates, how these different asset classes kind of behave. Because depending on your investment goals, you want to choose the right asset class to meet those needs. Let's say that you wanted to invest in something but really needed to use your money in the short term. Let's say that you wanted to grow your funds to help save for a house in 2 years. Well, one of these volatile asset classes isn't going to be something that you want to invest in, because if you get the timing wrong and the value of the asset drops by the time you need your money, well, you just lost money. So something with low volatility, such as fixed income, would be more appropriate because there's not much risk from losing value by the time you need your money. But let's say that you didn't need your money for a long time, such as a few decades. Then these rapid price volatility swings wouldn't really matter because over time, assets tend to grow, right? So the main assets that are really a staple of anybody's portfolio is going to be equities. And then the next thing is real estate, because those are the two that over time grow the most. So this chart right here shows the past 19 years dating back from the year 2000 to 2019. And you can see this blue line, which is equities. These grow the most, right? They're going to have large volatility swings at some point, but given enough time, they tend to grow. And real estate, they grow not as much as equities. They still have the same volatility range as equities, but given enough time, equities tend to outperform real estate. They tend to outperform everything, right? So that's why equities is a core staple of anybody's long-term investment portfolio. Now, let's say that you wanted to actively day trade the markets to try to produce weekly or monthly income. Volatility is going to be your friend because you can't profit from something that doesn't move much in a short time period. So that's why day traders mostly trade equities and commodities. But since these are very volatile in the short term, you have to know what you are doing, which takes education, practice, and experience. All right? So that's the different asset classes and how they behave. I hope you all learned something. Thank you so much for watching.